Here's a number that stopped me cold. 84%. By some estimates, that's how many seniors have never properly filled out one small bank form, a single line, really. And here's the part that grounds it. Even the most recent national surveys show that well over half of American adults, somewhere around 60%, don't even have a will. And by some counts, as many as 3 out of 4 haven't put these basics in place at all. So this isn't a rare problem, it's the norm. And that one blank line could cost your family around $15,000 and lock up your money for well over a year at the exact moment your loved ones can least afford it. The part that makes my blood run a little cold? Your bank knows about this form. It's sitting in your file right now, but they will almost never call you, mail you, or sit you down to explain it because it's optional. It's buried in the fine print, and a busy branch has no reason to slow the line down to walk you through it. So today, I'm going to be the one who does. Stay with me, because in the next few minutes I'll show you exactly what this form is, why it quietly overrides even your will, the 3 mistakes that cost families the most, and the simple 10-minute fix that's mostly free. And near the end, I'll share one bonus setting that protects your money while you're still alive, not just after you're gone that almost nobody sets up. Let's get into it. First, let me be clear about who needs to hear this, because it's more people than you'd think. If you have any bank account in your name, a checking account, a savings account, a certificate of deposit, this applies to you. If you're married, it applies to you and your spouse. If you're widowed, it matters even more, because that second safety net of a joint owner may already be gone. And if you have children or grandchildren, you'd want to leave something too. Then these next few minutes might be the most valuable 10 minutes you spend all year. But I want to speak directly to the most careful, most organized people watching right now, the ones already thinking, I've got a will, so my bank account is handled. I understand completely why you'd believe that. It's what most of us were raised to think. But it is the single biggest misunderstanding in this entire subject, and clearing it up is exactly where we have to begin. Here is the truth that surprises nearly everyone the first time they hear it. Your will does not control your bank account the way you assume it does. When it comes to a bank account, one small designation can legally override your entire will, every word of it. That designation is called your beneficiary. And on most bank accounts, you'll see it written as payable on death, or simply the letters POD. Think of it exactly like the beneficiary on a life insurance policy. Whoever is named on that line receives the money directly, quickly, and privately, and it does not matter what your will says. It does not matter what you told your family 100 times over Sunday dinner. The account beats the will, full stop. And this is not some fringe technicality. The outdated or missing beneficiary is one of the most common points of failure families run into. The classic nightmare being an ex-spouse who's still listed decades after the divorce and who legally walks away with everything. Now, when that beneficiary line is filled in correctly, it is a genuinely beautiful thing. Your money skips the courtroom entirely and goes straight to the person you chose, often within days of the bank receiving the paperwork. No judge, no lawyer required, no painful delay. But when that line is left blank, and I cannot stress enough how often it is left blank, something very different happens. The bank is legally required to freeze that account, and your money gets pulled into a slow, court-supervised process called probate. Let me show you just how expensive and how slow that really is, because vague warnings never helped anybody. Commonly cited figures put the probate process at anywhere from about 9 to 18 months. And by some estimates, the national average runs closer to 16 or even 20 months. And it typically eats up somewhere between 3 and 8% of the estate's value in court filing fees, attorney fees, executor commissions, appraisals, and publication costs. On a $500,000 estate, that works out to roughly $15,000 to $40,000 just gone. In some states with fixed fee schedules, it climbs even higher. On a $1 million estate, the combined attorney and executor fees alone can push past $40,000. That is money that was supposed to go to your spouse, your children, your grandchildren, handed instead to a process you never agreed to and never needed. And here's the part that's arguably even harder than the money: the time. During that entire stretch, sometimes 2 or 3 years, if there's any dispute, the account stays frozen. Now let me pause and be completely straight with you, because you deserve honesty. I am not an attorney, and I am not a financial advisor. This video is not personalized, legal, or financial advice. It's general information to help you ask smarter questions. The exact rules and costs vary a lot from state to state, and your situation is uniquely your own. So please use this to get informed, and then confirm the specifics with your own bank or a qualified professional. Fair enough? It's good. And let me make this real for you, because it's easy to hear numbers and shrug them off. Picture a woman. We'll call her Margaret, 72 years old. Careful her whole life. She had a will drawn up properly that said everything split evenly between her two kids. When she passed, her family found a savings account with about $47,000 in it, and the payable on death line was blank. Not because she was careless, but because nobody had ever pointed to it. That $47,000 sat frozen for 14 months while the court did its work. And by the time it was released, several thousand of it had been eaten up by fees. Her kids couldn't touch it to cover her funeral. They paid for that out of their own pockets, in the middle of grieving. One blank line did all of that. So now, let's make sure it never happens to you. Starting with the 3 mistakes. And the third one catches the careful, responsible people the hardest. The first mistake is the one we've been circling, leaving that payable on death line completely empty. And I want to be gentle here, because it is almost never anyone's fault. Most people left it blank simply because, on the day they opened the account, nobody asked them to fill it in. Maybe that was 30 years ago. Maybe the account has passed through 3 different bank mergers since then, and the old paperwork quietly vanished in the shuffle. Maybe you set it up during a chaotic season of life and never gave it a second thought. That's completely human. But here's why it's so dangerous today. If there is no beneficiary named and no living joint owner on that account, the bank has no legal choice when you pass. They must freeze the funds and wait for the courts. It will not matter how clearly your family explains what you wanted. The good news is that this is also the single easiest thing in the world to fix, and I'll show you exactly how in just a few minutes. But first I have to warn you about mistake number 2, because a lot of well-meaning people try to dodge mistake 1 and accidentally create a far bigger problem. Mistake number 2 is adding your adult child or a sibling or a trusted friend as a full joint owner on your account, usually with the very best intentions, so they can help me or so someone can get to the money if something happens to me. It feels smart. It feels simple, and it can backfire in 3 ways that almost nobody sees coming. The first, the moment you add someone as a joint owner, that money is legally theirs. 2, not someday, but today, right now. They can walk into the branch this very afternoon and withdraw every dollar, and they do not need your permission. I'm not saying your loved ones would ever do that. Most never, ever would. But you've handed over that power, and you can't easily take it back. The second, and this one truly stuns people, your money is now exposed to their problems. If that person gets sued, if they go through a divorce, if they fall behind on a debt, and a collector comes calling, your life savings can be treated as their asset, because legally, it partly is now. So let me stop and ask you something directly. Picture your own account for a second. Whose name would you add if you had to add one today? Now imagine that person 3 years from now, going through the worst season of their life, a lawsuit, a divorce, a mountain of debt they never saw coming. Would you still hand them the keys to everything you've saved? Sit with that for just a moment, because that is exactly the scenario families walk into without ever meaning to. And quick, if this is already opening your eyes, do me one small favor and type "eyes opened" down in the comments. It genuinely helps this video reach more seniors who need to hear it before it's too late. Now, that leads straight into the third way it backfires, which flows right into mistake number 3. When you pass, a joint account typically goes automatically to the surviving owner, even if your will plainly states, in black and white, split everything equally among your children. Because, as we said, the account beats the will. Families have been quietly torn apart over exactly this, not out of greed, but because of a setup that did the precise opposite of what mom or dad intended. There is a much safer way to give someone access, and I promise I'll show it to you in the bonus, so keep it in the back of your mind. Mistake number 3 is the sneaky one, the one that gets the people who actually did everything right. The planners. The organized ones. The folks who filled out every form correctly 20 years ago. The mistake is this: naming a beneficiary once, long ago, and then never checking it again. Because life keeps moving, doesn't it? People we love pass on, marriages begin, and sometimes they end. Grandchildren arrive who weren't even born when you signed that piece of paper, but that little form does not update itself. It just sits there, frozen in time, patiently waiting. And when the day finally comes, the bank does exactly what the form says. No more, no less. So picture the heartbreak of a form that still names an ex-spouse you parted ways with 15 years ago who now legally receives everything while your current family is left with nothing but a court fight. Or a sibling who has already passed away, which sends the money tumbling right back into probate anyway. The bank cannot use common sense, cannot pause to ask what you surely would have wanted. It follows the name every single time. So this is not a set it and forget it decision, it's a set it and then check it every couple of years decision. A 5-minute review can spare your family an outcome you would have absolutely hated. Alright, those are the 3 mistakes. So now let's fix all of them. And I think you'll actually feel relieved at how simple it is. If you can, grab a pen and paper right now, because I want you to genuinely do this, not just nod along and forget it by dinner time. Step 1. Contact your bank. You can walk into a branch, or in most cases just call the number on the back of your debit card. And here's the exact sentence to use, so you sound like you know precisely what you want. Say, I'd like to review and update the Payable on death beneficiary on my accounts. That one line takes you straight past the small talk and directly to the right form. At most banks, it is completely free, and it often takes less than 10 minutes. Step 2. Name your beneficiary clearly, their full legal name, not just my daughter, but her actual name. And if the bank allows it, add their date of birth too, because that small detail removes any confusion later. Step 3, and this is the step almost everyone skips. Name a backup, which is called a contingent beneficiary. Think of it as your safety net. If your first choice passes away before you do, the backup steps in automatically, and your money still skips probate and lands exactly where you wanted. Without a backup, that entire account can fall right back into the court system. Step 4. Do this for every single account you own, your checking, your savings, each and every CD, because they each have their own separate form, and filling out one does not cover the others. I've seen people fix their checking account, feel that wave of relief, and leave a much larger savings account completely unprotected. And Step 5. Set a reminder to review these names every 2 years, or anytime there's a major change in the family, a marriage, a birth, or a loss, as promised. Here's the bonus, and it solves that very trap we talked about in mistake number 2. Remember adding a full joint owner was risky because it hands over actual ownership of your money? So what do you do if you genuinely need someone to help you to pay the bills, to manage the account when you're traveling or unwell? Here's the safer path. Ask your bank about setting up what's often called a convenience account, or adding an authorized signer, or in some cases using a properly prepared power of attorney for banking. The difference is enormous. A convenient signer can help you run the account, deposit checks, pay the bills, keep everything moving smoothly, but they do not legally own the money. It is not exposed to their debts or their divorce, and it does not override the beneficiary you just carefully set up. So you get all of the help and none of the loss of control. When you call your bank, ask them this exact question and write it down first. What are my options for letting someone help me manage this account without making them a joint owner? That single question can protect you from the most common and quietest way that seniors lose their grip on their own money. Most people never even think to ask it, but now you will. So let's lock this in, because a plan you actually remember is a plan you'll actually use. Number 1, fill in your Payable on death beneficiary and a backup, so your money skips probate and goes straight to the people you love. Number 2, think twice before adding anyone as a joint owner. A convenience account or an authorized signer is usually the far safer way to get the help you need. And number 3, check your beneficiary names every couple of years. Do those 3 simple things, and you'll have protected your family from one of the most expensive, most heartbreaking, and most completely avoidable mistakes in all of retirement. Not with an expensive lawyer, it's not with a big check, but with about 10 honest minutes and 1 simple form. Now I've got a real question for you, and I'd genuinely love your answer down in the comments. Did you already know that your bank's beneficiary form can legally override your will? Just type yes or no below. It honestly helps me understand what to cover next, and it helps the next person scrolling by decide whether they need to watch this too. And if this helped you even a little, please do one kind thing today. Share it with someone over 65 who has a bank account, a parent, a neighbor, an old friend. You might just save their family $15,000 in a world of heartache, and they'll never even know it was you quietly looking out for them. If you want to keep protecting what you've worked your entire life to build, go ahead and subscribe and tap the bell. Because next, breaking down the one Social Security decision that quietly costs retirees the most money, and exactly how to avoid it. You truly do not want to miss that one. Till then, take good care of yourself and take care of that form today. It'll only cost you 10